Gentlemen, how are we doing?
Good.
Great.
How's it going?
Hey, cannot complain. It's going well this way.
Getting some good weather here in the Midwest. Always enjoy that.
Yeah.
Getting out of that cold feels good.
Ironically enough, we share a similar climate to the financial hub of the world, New York City. And so think of this, as we're talking about here in the Midwest, enjoying the nice weather, we only have certain amounts of time where we get that.
Right.
And their climate is no different. So interesting to kind of observe, you tend to see volume drop in the summer months in the markets. And all volume is who's showing up to trade, if you will. So it's kind of interesting to anticipate. And, is there a strategy that goes along with that? Maybe. It's a data point to keep an eye on.
Is that why they say go away in the summer?
Yeah, perhaps. But it's interesting, and we get to live it here in the Midwest. But it is nice to get some good weather. Those down in the South, I know it gets a little hot around this time. Yeah.
So if we look back in June, as we start to roll into the summer, we just talked about the volume. So let's look at the markets.
Yeah.
What did they look like?
June was a robust month across the board. Yeah. Most assets went up. We like to look at the S&P 500 and the aggregate bond index. No disappointments. You look at let's start with the S&P 500, the top 500 companies in the U.S. Looking at the total return for the month, 5.09% to the upside. Tremendous. Mm-hmm. We'll get into kind of why that played out, we think, and give you our perspective. But then bonds were not left behind either. The aggregate bond index, which is a basket of bonds, kind of generally speaking to that asset class, up 1.54%. Bonds, remember, we've been talking about this for years. Their interest rate volatility leads to bond market volatility. Interest rates often are tied to inflation expectations. It's a theme that we continue to have to pay attention to. But again, June was a good month for most asset classes.
So with the volume, with the markets and how they did turn and how they started to move, it did. When we look at the portfolios, that we try to design and construct, anything that we should touch on there?
I think that when you think about portfolio management in this environment, it's certainly a headline-driven market. Headline-driven markets tend to come with more volatility. And so you really have to have a check-it-down system in place to understand the environment that you're operating in. So some of the liquidity, credit spreads, those will dictate our risk-taking behavior in the equity side, the stock side of portfolios. It's a okay place to be right now.
Right.
It's an okay place to be right now. So really a lot of the focus on our tactical movements have been in the fixed income side, because that's where that interest rate volatility is playing out. And a lot of that interest rate stuff tends to be driven by policy decisions. Well, as we know, pay attention to the headlines. A lot of the policy is moving rapidly. Yeah. And that's what you'd expect in, first 100 days of a presidency and things like that. So when it comes to the portfolio, our retired clients are probably more seeing movement as we navigate through that fixed income side of things and trying to, hook up and benefit from some of that interest rate volatility. So I've got to say we've been doing a pretty good job keeping on that. Yeah.
It really has.
Yeah.
And as we kind of stay with this theme of markets and maybe decisions with the portfolios, and I think, we do talk a lot about historical data.
Right.
But I guess we've had some historic data here looking back, right?
So just if you haven't watched our May podcast, you might go back there to recognize we just had May and June, 2 consecutive months of robust movement to the upside. Maybe when you're looking at the S&P 500, that's kind of what we like to focus on here. Again, top 500 companies in the U.S. We haven't seen a back-to-back gain since September of 2024. Now, that's not that far in the rear view, but it just speaks to when you can start to see confidence stacking up like that in risk-seeking behavior, things like that, you're starting to see more confidence, I think, in risk assets, and that's really important. And the magnitude of the move that we saw May to June, those 2 consecutive months, the magnitude, the amount of gain that we saw, we haven't seen that since December of 2023. Now, it took a big hole, that was created, and oftentimes, that's what would drive such a robust and potent move to the upside. But we got it. And so, again, I just touched on that check-it-down system to keep us in the right places through challenging environments. Headline-driven markets drive volatility, but volatility alone isn't a reason to exit a position. It just comes with the territory. But you need to know whether that volatility comes with a potential payoff that would be idyllic for, just riding through it. And again, I think that the systems that we're using will allow us to throttle up, throttle down properly. So it's been good. And, to see the historic movement in the markets, it's, I guess when the weather's nice, we get to enjoy a little bit. If we find some free time,
Well, and looking through historical data too, right? When you have big rips to the downside, it tends to be followed by a similar move back up. Now, a lot of that, like we said, maybe came from that Liberation Day, right? Where global trade was really kind of upended and a lot of uncertainty around what trade was going to look like. Coming into June now, we've got some trade deals that have been completed. One with one of our biggest partners or adversaries, whichever way you want to look at it, but with China. Yeah. What does that kind of look like here moving forward?
This might sound bold to a degree, but it's really the only deal that mattered.
Right.
Think about the products that you use day to day. And you probably try and get American-made products and stuff, but think about what are you constantly seeing made in where? Okay. That right there, that simple observation tells you how important it was for us to have a productive and perhaps constructive deal with China. They are very, very important. Now, if you think about the headlines, we haven't gotten deals done with everybody, but that one deal propelled us to historic movements in the market. Now, I'm not saying that there aren't other deals that are important, but that one right there was one that we could kind of breathe a sigh of relief. Happened in June in London. Trade delegations got together, and so that was really good. Hopefully, it can continue to be honored, and we can move past that one constructively.
Right, and like you said, there's maybe some second half predictions. Do we think we're going to get more trade deals done? What do you think is going to happen with the economy, markets, the Fed with interest rates? I mean, can you give us any predictions out there so we can look back maybe in a few months and say, hey, Ryan was right again?
Wow, wouldn't that be nice? But, when you really think about what we try and do on this podcast, it's like, look in the rear view, but we're trying to look out the windshield a decent amount here. And, we just closed this first half of the 2025 calendar year. Amazing. Again, you look at that backdrop of what matters to markets, capital markets, equity markets. We focus on the stock market, so let's just kind of stick with that for the most part. There are things that are brewing right now that would drive you to a conclusion of bullishness. Now, headline-driven market, though. Bullishness with volatility. And so I do believe, and we talked about this, the S&P 500 hitting 7,000, that's not that crazy. Earnings are there, liquidity is there. Think about, and we'll talk more about this next month, but any bills that would be passing through Congress that would increase, spending and stuff, that's fiscal stimulus. And then clearly there's a lot of pressure on the Fed to cut interest rates. That's monetary stimulus. You get those two things pushing in together. And, corporate America, I think that the last that I saw, S&P 500 earnings are projected to grow at 5% this year. If we can hit this stuff, the backdrop looks really good. And that's, again, this is such a divided political environment, too. You have, I think, suppressed assets that maybe aren't risk-seeking, that haven't come into the market yet. I just saw a statistic about, trillions of dollars in money market funds still to this point. So I think the backdrop is pretty robust. Clearly, with the movement that we've seen here recently, the market probably has to digest. And you get that low volume in the summer. So again, some volatility, some digestion, but the backdrop looks pretty good.
Well, and even with some of the things that we talk about, right? Water cooler, but some of the statistics, M2 money supply.
Oh yeah,
that's looking pretty good too.
Global M2
for more bullish
in the U.S. And M2 is just, again, simply stated, it's the money that's waiting to enter the market. It's a manifestation of the liquidity in the economy. So whether that's U.S. or global. So again, all these things are stacking up. But recognize changes quickly. You got to be paying attention. You got to have systems in place to capture. But I think looking into the second half, we can be pretty confident.
Right.
Kind of switching gears, historical wise too, the dollar is depreciated quite significantly, over the last 5 months.
Right.
A lot of different factors that can come to play there. Give me your thoughts on why that might be happening.
So the dollar has really seen quite the unwind. It's not that we haven't seen these levels before. It's just the unwind came pretty quickly. But I think you had a couple different forces playing out this year with respect to the strength of the U.S. dollar. Those forces are such. Imagine if you continue to spend more as a nation than you bring in revenue, if you will. Well, then you're printing dollars, you're creating dollars. Well, why is a Mickey Mantle rookie card worth something? Because of scarcity. If they were in every single pack with the stale stick of bubble gum, they really wouldn't be that valuable. But scarcity creates that value. So now let's think about dollars, right? And we've talked about this before. As we create more dollars, each one is worth less and less. Okay, so you've got that playing out. There's not been a tremendous amount of austerity within our government. And again, we'll get into some of the logistics behind it next month, but you still have deficit spending. You still have a debt that keeps growing here in the US. So the money creation is there. And then imagine you go and upset a bunch, or I could say it better, piss off a bunch of your trade partners around the world by making them come to the table and rehash arrangements for trade. It doesn't really make them too happy or thrilled. So what do? They sell your dollars, right? They sell your dollars, they sell your stocks, they sell your bonds. I mean, you look, international stocks have had a pretty good year and they've needed it. But imagine you're a sovereign wealth fund and you sell a bunch of US stocks. That money's got to land somewhere. You're probably looking outside the US for it to land. So there's some dynamics playing out that are from just the trade negotiations and then just how we're running our country. And but imagine this, and it's a societal issue, and I'll explain why, but give me a minute. If you own a stock and you own a company, that's essentially what it is. You own a stock, you own a piece of a business, $100 a share. So it's got intellectual property, real estate, inventory, whatever, a lot of stuff within that entity, $100 a share. The next day we wake up, it's $110 a share. You go, oh my gosh, did they get a new deal or something? Well, no, they didn't. Well, what happened? The business got more valuable. No, the dollar got less valuable. So now it takes more dollars to buy that same unit of ownership. That is why, stocks and assets are a great hedge against inflation. Right. Now, tuning into this, you probably have those. There's a lot of people in this world and in the United States that don't have portfolios. They're simply confronted with the weaker dollar, the higher prices, and they have no hedge against it. So, again, there's a lot to unpack there with the U.S. dollar, but how it impacts our client portfolios, when that weakens, it actually does good things.
Yeah. So as we kind of look back at the month, right, we've talked a little bit or a lot about, the markets and, what's gone on and maybe what we see. But one thing we didn't even talk on, which is always kind of like the background or the drumbeat in the background, or geopolitics, right? Yeah. And I think, between, the higher, in higher visibility things that were going on, obviously was Gaza and Israel and Iran, and then how we entered it. But I guess, Ryan, if we look at the markets through some of that, and I don't want to say noise to make it so it wasn't important, but it was noise, right? Mm-hmm. It's always going on. It's always happening, not the specific things, but the geopolitics of the world.
Yeah.
What do you think?
You got to unpack this and remove the emotion from it and say, there's some humanitarian issues around the world that would just keep you up at night. And, they're terrible, certainly. So, that aside, recognize you kind of have to pull from history and say when you're seeing these incidents of war, incidents of geopolitical tumult, you don't run from them.
Right.
We haven't. Granted, each one is different, but historically speaking, and we've got to use history to create our rule book, if you will, when it comes to managing money. It's, I guess that the tension in the Middle East is certainly something we got to keep our eye on. It, though, drives what are called tail risks. So think of the Gaussian distribution, a bell curve, you know, we've all seen it. And we always hoped our tests would be graded on a bell curve, right?
Right.
But, right, you've got 95% of your typical outcomes, your data points, will come within 1 standard deviation, 2 standard deviations from the mean, the average. But then you have these things that tails, 2.5%, 2.5%. There are things that exist out in the tails that could impact a stock market, a bond market, but you're typically going to be reactive to those rather than proactive. We want to be proactive on generally what would have a high probability outcome.
Yeah.
So, you know, you've got to be aware of your tail risks out there. And I think these geopolitics can spill over into that. But I think what a lot of it is creates a lot of headlines. And again, I'm just talking from an investment standpoint.
Exactly.
Creates a lot of headlines that drive volatility that oftentimes we could find opportunity.
So let's look ahead a little bit. You kind of mentioned a few things that we're going to maybe get to next month.
Yeah.
You know, so if we look ahead into July, you know, we talked about some bills. We got some other things kind of popping up.
Yeah. So looking ahead, we want to take a look at, you know, the Trump administration's bill that's going to kind of set a budget for the next little bit here. That will dictate a lot of that, you know, deficit spending, you know, stimulative, money creation, stimulative. We're also going to have to take a look at what's going on with the Federal Reserve and where are interest rates at. Interest rates at the Federal Reserve level, the federal funds rate, but then also just, you know, how does that play into the market-driven system? You know, everybody thinks about the Fed lowering rates. That's just the anchor point on the yield curve. There's a lot of other interest rates that we got to kind of keep our eye on. So, but those are going to be two things that we really hope to get through and unpack for you next month. But again, looking ahead, I think that we need to seek opportunity and seize it.
Yep. Well, hey, we'll be here for it. We'll be here to talk about it.
Absolutely.
We'll see you two later, and we'll see you next month.
Thanks for tuning in.
Advanced Capital Management Incorporated is a registered investment advisor. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor before implementing any strategy discussed herein. Tax and estate planning information should not be construed as formal legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation. Thank you, and we look forward to seeing you next month.